Welcome, everyone. Thank you for taking the time today to join me as I talk with Horizon Investments and share the next hour with you on investments and a good discussion about the markets and where Horizon sees them moving forward. A few housekeeping items, if I may, before we get started. The first is you'll notice in the upper right-hand corner of your screen the ability to view the video conference in either gallery mode or speaker mode. Gallery mode will allow you to see all three of us at the same time on your screen, the Brady Bunch view, if you will, of the video conference. Speaker mode will move the person who is asking or answering the question front and center on your screen during their question or answer. With that, the quarter has come to a close. You'll be receiving your statements shortly. I would encourage you all to please go on to the Tranquilli Financial Advisor calendar link and schedule an appointment once you've had a chance to review the statements. To say the market is off to a challenging start in 2020 would be putting it mildly. Generally speaking, we're talking about the stock market being off to a rough start, but the bond market has had its own challenges during this time as well. We'll talk about that with our guests today. You can see that I've spent a lot of time at the office. I've talked about many things, and one thing I do want to point out before we get there is that having a partner like Horizon Investments working with us really allows us to handle a market like this patiently and confidently. And what I mean by that is you have several perspectives from an analyst view looking at your portfolios on a daily basis. It's not one financial advisor, it's not one analyst. You've hired a team to work on your portfolios. Horizon is part of that team, and I'm glad to have them with us today. I started to say I've sent out several emails. I've had phone calls with many of you. I do appreciate that. I have been at the office all hours, and I just love doing it on your behalf. It has left absolutely no time to shave. So as part of this video conference, we certainly will ask for your thoughts after it's over. Send me an email. Let me know what you think of it if you'd like to see more in the future. And you are welcome, as others have, to comment on the beard. It's been a fun reading those comments. And I would share with you that, as one client said, everyone needs a hobby, and what else is there to do right now? So with that, I will get to the main reason we're here, which is our guests. We have with us Josh Bartholomew. Josh has been with Horizon Investments since their inception in the early 2000s. I've had the pleasure of knowing Josh for over 15 years now. I can say that we've been through several markets like we're experiencing currently. Josh is practice leader for Horizon Investments, and what that means is Josh travels the country, meets with multiple financial advisors on a daily, weekly, and monthly basis. Happily, I can say that Josh comes back to Clinton, New Jersey often, insists that I take him to the Clinton House, and of course, while we're there, he lets me know that Tranquilli Financial Advisor is among the very best that he sees when he travels, and certainly I appreciate that, Josh. Joining him is Austin Fitch. Austin is a senior analyst with Horizon Investments. He's been with the firm since 2011. Austin is a certified financial analyst, which is the highest educational designation one can receive in the financial field. Austin, most importantly to you as Tranquilli Financial Advisor clients and friends, has been through multiple grillings by me on your behalf. And I will share with you that not only has Austin come through those grillings just fine, he's offered perspective that maybe I didn't have going into them, something that I've been able to share with you and come back as a better financial advisor, able to communicate what is happening within Horizon Investments. And more than once I've said to Austin, why the heck are you doing that? And why are you doing it right now? And he handles it very well. So what I'm going to do is turn it over to Josh Bartholomew right now. I will be back to ask the questions that I had prepared for Josh and Austin previously, and of course share with them the questions that you as Tranquilli Financial Advisor clients have sent to me. I do appreciate those. One last thing, if you're new to Tranquilli Financial Advisor through this video, please send me an email. I'll share with you my calendar link, and we can plan a time for a good discussion. Go ahead, Josh. Thanks.
Lou, thanks so much for having us. And honestly, it's just a great opportunity for us to do this. I want to thank all of you that have joined us and many of you that actually logged on early today. It's incredible that at a time like this, we can all be together and yet not be together. And because of that, because small groups, study groups, churches, everyone's meeting online, we have to find times off the top of the hour to meet. So we waited till 11:15, and we're grateful for your patience for that, because the bandwidth dropped significantly between 11 and 11:15. Not something we thought about before last week, but thank you for your patience. And again, thank you, Lou. It is true that I wish I had a flight to New Jersey and I could come to the Clinton house this week, but who knows when that might happen. You'll have to send me takeout from New Jersey. We'll see. I don't know if Uber Eats goes that far. If it does, we should all look at that company as a purchase. Anyway, that's a different story. Austin also joins me here from Charlotte. Although we're both in Charlotte, we're not together. But Austin Fitch and I run our consulting group. All that means is that we work with about our top 50 advisors around the country, and Lou has it right. I do travel quite a bit, get to meet a lot of different advisors and many of their clients, and many of you I think I've probably met in the past. Some of you I haven't. Hopefully when this clears up, I will. Some of you might be new to Tranquilli Financial, and the fact of the matter is Lou says it correctly. There's a lot of advisors out there. Not all of them are doing it right. And this kind of video call that we're trying to put together here is a good example of that. Most people are not talking to their clients in the midst of turmoil and a lot of volatility and uncertainty. And this is the second call we've done with Lou and his clients in order to be out in front. And that should tell you a lot about the way he thinks and the proactive way he's trying to work to communicate to his clients. And we want to support that effort. And that's why we're helping be a part of this. Now, I do have the privilege of having with me Austin Fitch. He's really the smart one in the room. And so I'm going to hand it over to him. And Austin, I think as we kick this thing off, we've got an hour. Lou's got a ton of questions I know that his clients have already sent in. But why don't you give us a sense of, we had a sell-off at the end of last week. Now we're rallying this week. It's really hard to make sense of where we are. Can you make sense of it at any level? And what should we be expecting kind of as we look at these markets on a short-term basis, let's say the next 6 to 8 weeks?
Yeah, Josh, that's a great question. And Lou, thanks again for having me on. I think maybe to set the framework for the moves that we've seen so far this year, I think really you got to go back really to the end of 2019. 2019 was a historic year on the upside. You had strength really across equity markets globally that set the stage for obviously where we are today. I think what you saw as 2020 really kicked off, January was a pretty strong month, just generally speaking. But then as you got into February, you really started to see some uncertainty enter the markets. And at the time, obviously the coronavirus and COVID-19 specifically was an issue, but it was confined to China. And what I would tell you is the markets, the uncertainty that the markets experienced during the month of February was really just driven almost entirely by the political conversation that was going on at the time. Most of us don't even remember, but that was as we were getting into really primary season, and Super Tuesday was a big topic of conversation there that first Tuesday in March. And the risk to the markets was that a candidate like Bernie Sanders, which was supporting more of maybe a socialist type agenda, was risky from a market perspective. Again, not saying anything along the social side of things from his agenda standpoint. We won't make any judgment one way or the other on any of that. But what I would tell you is that the markets were a little concerned about how his agenda would affect the bottom line when it came to business. And you saw that, again, second, third week of February really start to leak into the markets from an uncertainty standpoint. Fast forward a couple weeks after that, and you had kind of that OPEC conversation with Russia, and those talks start to break down. You saw a large, I would say, drop in oil prices really that first week of March. And that was kind of the second catalyst, if you will, that really added uncertainty to the markets. So you have the political side, you obviously have the global oil conversation that's going on, And then finally, the coronavirus piece really took hold as we got into March. And because what I would tell you is it didn't really start to impact markets until we started to see just how widespread that was from a market standpoint, and just how big of a impact it was going to have on a global economy. So I think you saw that as we got into March. I think what happened from that standpoint was the uncertainty really started to take hold. And I know, Lou, we've talked about this a number of times, but markets serve as what we would call a discounting mechanism. And really all that means is they're trying to price stocks and bonds in the future. And markets can deal with what we would call risk. Risk can be quantified, right? But markets don't deal well with what we would call uncertainty. So the unknown unknowns, if you will. And if you look at that, this coronavirus, as it has really taken hold globally, it falls into the category of uncertainty. I think we can make the case that even today, we still don't know the depth to which it will have an impact on the U.S. economy. We don't know how long businesses will be shut down. We don't know how long stay-at-home or shelter-in-place orders will remain in place. And that uncertainty has really been what's led to market volatility on both the up and the downside. You saw a couple weeks ago, you saw significant down moves to the tune of 6, 8, 10% a day on the downside. But what I would tell you is then the following week, markets were up 21% over a 3-day period. Again, volatility in both directions coming from that uncertainty, coming from the idea that those headlines as they come out are really driving prices wildly in both directions. And the fact that you see that is, again, historic to say the least. But what I would tell you is as we start to get more and more certainty into the marketplace, you would expect that volatility to come down, not to suggest that markets go up immediately once we start to get those answers. But as certainty does creep back into the market and you get more meaningful data around the virus, around the economy, I think that's when you start to see markets start to behave more normally, if you will.
Awesome. With that, if you don't mind sharing, then where are you looking at as one of the analysts at Horizon Investments? Where are you looking at and from a short-term standpoint, from a mid-term and even a long-term? And by short-term, we'll say the next 60 days of market investing. Mid-term, we'll make that closer to the end of Q3, and long-term, 2021 and beyond. Are you having conversations internally? What are those conversations? Where are you looking at markets right now? And certainly I would appreciate even a conversation, certainly on the stock market, but the bond market as well is something I think we need to really go over as well.
Absolutely. I think that's a fair question, and something obviously that we're looking at on a daily basis on our side. What I would tell you from a short-term perspective, where we continue to see opportunity is really in kind of what most folks would consider kind of growth-oriented stocks. So those are your technology stocks or your healthcare stocks. And the reason that we're looking at those currently kind of in the short term is they're actually positioned well to benefit both on the up and the down in a volatile market like we're seeing today. And the reason being on the downside, the companies like technology and health, those technology and healthcare companies are really set up to benefit from the environment that we're in. And what I mean by that is if you think about technology, for example, Amazon is maybe a good example to run through. They have actually said that with the first quarter and really with the pandemic in general, that they're going to see revenues and earnings numbers probably in line, if not ahead of expectations. Technology companies have actually, in many cases, benefited from this drive to a work from home environment, whereas maybe more consumer-based type of companies, whether they're restaurants, whether they're hotels, whether they're airlines, those are the companies obviously that have been hurt more, but companies that benefit from the technology component whether it's an Amazon or even an infrastructure. Zoom is a perfect example of I would say a webinar technology that up until 3 weeks ago, probably most folks on this call, most folks generally had never heard of. Those types of companies stand to benefit nicely from the recent bump on the down, but I would tell you on the up, they're still going to participate in that upside, those upside moves. The healthcare component is probably equally as, in terms of makes sense. If you think about on the downside, generally those are the companies that are more protected from downside moves. What I would tell you on the upside, those companies are the ones that are working on solutions. And what I mean by that is whether it's vaccines, whether it's treatment plans, whether it's medical equipment, all of those are pieces that the healthcare stocks just generally is an area where we think we see opportunity heading into really the next, like you said, 60, 90 days in terms of a short-term outlook. What I would tell you as we get more medium and longer term, I think there's absolutely some opportunity in terms of those companies that have been maybe unfairly sold or sold off more than the intrinsic value would actually suggest. Those would be the companies that I was referencing earlier in regards to your airlines, for example, maybe your restaurant types of companies or your hotels. Those kind of consumer-driven companies, there's going to be opportunity there as we get on the backside of this pandemic. As you get out into 2021, I would tell you industrial and manufacturing companies probably stand to do well as really the economy starts to come back online. So I think that's where we're looking from an equity perspective. What I would tell you on the fixed income side is that credit and corporate bonds, basically credit, high yielding credit, often referred to as junk bonds, has been an area of weakness or an area of risk more recently. What I would tell you from within our portfolios is we've been transitioning to a higher quality of corporate bond where it makes sense to hold those corporate bonds. We've transitioned to a little bit more of an allocation towards treasury securities over this time. So really think about the bonds that you would want to ensure repayment. So better companies from a credit worthiness standpoint, and then also government securities are two areas where we think there's more safety in the current environment on the fixed income side, maybe than your traditional higher yielding bonds.
Okay. So with the bonds, if I can, and I've shared this in the past, I had a very, well, it was a good lesson in 1994 when the bond market melted down. And I stood there and I had a mentor that I worked with and I said, what are you talking about, the bond market's melting down? Bonds are guaranteed. And that occurred to start this market cycle. We did see, we witnessed weakness in the bond market. As soon as the stock market was dropping, we had money, we'll say, flooding out of stocks into bonds, creating a liquidity issue. And if I can ask you to discuss the liquidity issue that we recently viewed, which is similar to what happened in 1994, and in comparing that bond, I'll say, shakiness recently, even if you would explain what you're looking for in a high quality, but why are you looking at high quality bonds right now? Why aren't you looking, I'll say, back to the junk if there's any value there?
Yeah, no, for sure. And I think it's very important to highlight some of the risks that we have seen in the bond market. And I think you do a good job bringing up that point in regards to what we saw a couple weeks ago. What I would tell you is at the core of the bond market, really globally, is kind of what we would refer to as a U.S. Treasury bond. So those are, think of it as around the world, that's seen as kind of the risk-free asset. And what I would tell you is really it was the second week of March. People were having trouble pricing a U.S. Treasury because there was so much uncertainty in the market. And why that's important just generally is because if you can't price a security that's considered risk-free, then it makes it nearly impossible to put a reasonable price on any other security out there, whether it's equity or other fixed income or bond. And so when you saw that, call it 3 weeks ago now, you really saw those gyrations both on the equity but then also on the fixed income side. The fact that you brought up liquidity being an issue, almost think of that as there were more sellers than there were buyers in the marketplace, and really caused an issue from a pricing standpoint to where folks couldn't agree on a price when it came to pricing out that U.S. Treasury or risk-free security. So you saw that, like you said, for the first time in quite some time a couple of weeks ago. That since then has really worked its way out. The liquidity brought forth by the Fed in terms of injecting liquidity into the system has absolutely helped. But I would tell you also there's been more certainty. There are fewer unknowns today than there were even 3 weeks ago, despite the fact that it probably still feels like there's so much that we don't know. So that has definitely helped as volatility has come down in the last few weeks. Maybe Lou, to your second part of the question there, what I would say from a quality standpoint, if you think about a company's ability to repay or to pay on their debt, that is very important in a time of stress like it is today. And I think what you're seeing is higher valuations being put on companies that are able to almost assuredly kind of repay or pay down that debt. If you think about a bondholder receiving that coupon payment, clearly they expect to, as you mentioned, they expect to receive that for the duration of that bond. Any risk of not being able to do that really leads to a pretty wild, volatile ride oftentimes. And that's why, from a positioning standpoint, we've shifted to more of that higher credit quality type of fixed income, where you're given a higher likelihood, much higher likelihood in many cases, of getting those payments on a consistent basis, rather than risking taking on maybe the possibility that those payments don't come through at some point for an individual company.
Hey, Austin, just if I could follow up, we're going to hear and maybe talk a little bit about what the government is doing. So from a small business standpoint, what this relief or stimulus effort might be. Can you talk a little bit more, maybe defining liquidity? I know Lou and I have talked about this, defining what the Fed's doing and what liquidity actually means, so these folks can hear kind of what that means when we see dislocations in the bond market and how the Fed steps in and maybe makes sort of a difference in terms of their efforts.
Yeah, no, we can definitely drill into that, Josh. I think the idea of liquidity, if you think about a marketplace where somebody's buying and somebody's selling, oftentimes what happens is somebody comes into the marketplace wanting to sell a security at a certain price, and somebody else will be in the marketplace wanting to buy that same security, but they don't necessarily want to do it at the exact same price. Say somebody wants to buy it at $100, but somebody wants to sell it at $101. So obviously what happens, just generally speaking, is that you'll meet in the middle to some extent. And that's, again, a very simplistic example of what you see on a daily basis in the markets, both on the equity and the fixed income side. What I would tell you is what you saw with the uncertainty is that you didn't have buyers coming into the marketplace at the normal frequency to really come in and provide that liquidity to take the other side of that trade. So you had numerous people coming in to sell securities. You didn't have nearly enough buyers at the prices that the sellers wanted, or for that matter, anywhere near where the sellers wanted. And that's where this idea of a stimulus, the Fed stepping in, really helps provide liquidity. They serve as that kind of buyer of last resort, if you will, which helps stabilize the market, helps stabilize prices in the short term, and really allowed, I would say, over the last couple of weeks, allowed for the market, specifically on the bond side, to kind of gain its footing again, providing those buyers to support that marketplace where they had been lacking over the past couple of weeks.
So the follow-up to that, Austin, would be, well, if everyone's looking to buy the high quality, and you would have to think logically everyone's trying to buy the high quality, doesn't that put pressure on the price upward? Has that happened?
You've seen a little bit of that. What I would tell you is you've actually seen a decent number of folks just kind of take money to the sidelines at this point, which has not led to massive price dislocations on the kind of the flip side of that. But Lou, I think you're absolutely right. As we continue to go forward and as uncertainty does continue to dissipate, that's something that will, I would say, continue to happen. That's also the time when you'll have more information, and maybe it does make sense to start to look for other opportunities in the fixed income environment. But I would tell you today that really hasn't been an issue so far.
So that leads to the CARES Act, which is $2.2 trillion. That is the start, from what we're all told. It certainly could be more than that. What just happened? And Josh asked the question, and you answered that. The government has created a buying. They are buyers of last resort. You've answered that already. What does the package mean for the stock market? Is some of what we are viewing today a result of the CARES Act, meaning the market, the stock market specifically? How does that $2.2 trillion impact us immediately and even long term? Does it impact us? I don't know that it's always a positive answer. It's money that is flooding, we'll say, the markets. Is it a positive overall as well?
I think that's absolutely a fair question, and I think what I would tell you is with the CARES Act and in terms of the stimulus that has been passed from the government, really that is an attempt to stabilize what I would call Main Street. And this is where there's a pretty large divergence between what we are seeing today and what we saw in 2008, for example. In 2008, really the drawdown in the market and the subsequent recession that we all experienced came from really a failure within kind of the financial system as a whole. Think big banks, think too big to fail, obviously. That conversation comes up. What I would tell you today is the risk is absolutely not in the financial system. The risk is not really even in corporate America generally. The risk, unfortunately, has fallen to middle America and small businesses. Mm-hmm. And that's where this CARE package is really, this CARES Act is really intended to provide support. You've obviously seen it with the amount of money that they're directing towards small business loans. You've seen it with the stimulus checks that are going to go out to individuals. This program, or this, I guess, collection of programs, is really designed to support kind of that middle America band where there's trillions of dollars in wealth tied to these small businesses. And the risk is that this shutdown of the economy that we're currently in the midst of puts these small businesses at risk in terms of long-term existence. We were talking about it actually this morning internally, is once this is all said and done, whether that's 6 weeks from now or hopefully not anywhere near, but 6 months from now, at the end of the day, folks are going to get back out and spend. And the risk, right, is that when they want to go back out and spend, that there aren't nearly enough small businesses that are still left for them to spend on, if you want to think of it that way. These small business loans are really designed to allow those businesses that are there on a daily basis, whether it's the local pizza shop or the local coffee shop that you see in your community, that we see in our community, is to continue to support them as the economy as a whole kind of comes to a grinding halt. Obviously, the risk is that either the loans don't get through in time or the businesses themselves have to shutter operations entirely. And that's where the risk is generally. That's where this CARES Act is really designed to provide support. I think a study came out at the end of last week, or a survey that suggested over 50% of small businesses have less than 3 months worth of kind of what we would refer to as reserves to support a shuttering of operations like we've seen. That's where the risk is to kind of small businesses in America, and that's where this CARES Act is really designed to support. The only other thing I would say on that is the checks that have been discussed to go to the individuals. That's for the folks that are affected by this in terms of, laid off, maybe less hours than they otherwise normally would get, to support those individuals in kind of that Main Street conversation again, to help them pay rent, to help them get the essentials, to get food, shelter, clothing, obviously as needed. And I think the risk there is the idea that if this liquidity, in this sense, doesn't get to the individual, if these checks don't get to the individuals quickly enough, that you kind of miss the window. I think we would all agree we've seen government stimulus in the past that has come in the form of a tax credit or a tax rebate. Unfortunately, if that were to be the case, which it's not, but let's just say if that were to have been the case in this act, and we all didn't get that $1,200 check or whatever portion that we may end up getting until 2021, the government's kind of missed the boat. Folks are going to need that money sooner rather than later. And I think whether it's the small businesses or the individuals, the ability for the government to get that money into the hands of Main Street sooner rather than later is very important.
Hey, Austin, if I could just follow up, and Lou, just to make a point. I think there's been a ton of news about how the stimulus thing is working, right? There's I think almost $400 billion or something in the package that goes to small businesses. And there's been a bunch of news about, well, it's taking time to get this thing through the system. But I spent a lot of time this weekend talking to friends of mine that are small business owners. And what I'm finding is the banks are being incredibly proactive in terms of what's owed to them and when that's owed, and landlords are doing the same thing. It seems to me that there's a ton of confidence from the lenders, the intermediaries, if you will, between the government and the small business owner. It seems to me that there's a lot of confidence. That says two things. I think one, this will get straightened out in terms of confusion around some of those loans, but also the banks are in a better position than they've really ever been historically. I mean, way better than 2008 when we entered this sort of crisis.
Yeah, Josh, I think that's a great point. If you look at the financial stability of the system as a whole, it really stacks up, I would say, historically well relative to what we've seen. So that is absolutely a help. And I think I saw something Friday. So when kind of those small business loans really started being made available, you saw, I think it was something into the tens of thousands in terms of those applications within the first hour of those being available. And the banks, again, they were, I would say, obviously overwhelmed in certain capacities. But to your point, they were absolutely doing their best in terms of really getting the money into the hands of these small businesses wherever that was possible, knowing that the government in this case is kind of providing that backstop from a funding standpoint.
Well, and I can share with you and with everyone on the call, I've had 2 emails this morning already from bankers who are working with clients that are part of the process of applying for loans. And in doing so, the bankers just need some additional information that was missing, and I'll get that back to them right away. Now, again, that program started Friday, and here they are already sending requests for information to help move that along. A few changes in there may or may not impact anyone on the call today, but I just think it's important to mention it, that it went from a 0.5% loan for 10 years to a 1% loan for 2 years. Now, all good. That's all good. But it was, I think, a bit of the banks standing up and saying, wait a minute, we still need to make some money here, and we can't do so with this. but with the backup or support of the government, certainly they are proactive, which is interesting to see. If you don't have any additional comments on the CARES Act, I'd like to bring it back to the investment side of things because we had some questions on that.
Yeah.
One of them touches on politics. We'll get to that one a little bit later. Okay, we'll touch on politics. We won't go into politics, but we'll touch on it. So Horizon, right now, are you looking domestic or are you looking at the opportunities outside of the U.S.? Assuming you're not investing in the stock market right now. Now, that may not be the right assumption. I certainly welcome your feedback on that and input. But assuming you're analyzing where you believe we should be looking, we talked about it a little bit earlier, but very specifically, are you looking in the U.S.? Are you looking outside the borders? What are you focused on right now?
Yeah, I would say so. Within our equity portfolios that are invested, what I would tell you is we definitely have a domestic tilt. We're heavier domestic than we've really been in quite some time. That being said, internationally, we do have a small allocation and have maintained an allocation to emerging markets. We are, I would say, almost entirely zeroed out from an allocation to Europe. We think Europe is going to be probably hurt the most from this pandemic, whether it's obviously what we've seen in Spain, France, Italy, those countries as a whole really experiencing some of the hardest times within the health side of things. But what I would tell you is, from an economy standpoint, the challenge of the European Central Bank trying to put forth a package similar to what the U.S. has done over the last couple weeks is really just that much harder. Think about how many countries live inside of the EU, and the ability to pass that type of legislation just doesn't happen even as fast as it's happening, anywhere near as fast as it's happening in the U.S. So from a Europe standpoint, severely underweight there again. But on the emerging market side, I think we do see opportunity there. And this is a little bit of an interesting time and scenario for emerging markets for a couple reasons. One, if you think of emerging markets, you probably most of you think of China as being the main player there, and that's absolutely right. And what I would tell you is this type of global pandemic is maybe the one time that it is beneficial to be under totalitarian or authoritarian rule. The ability of the Chinese government, as we've seen over the last 2 months now, to in essence shut off their economy and then turn their economy back on is something that would be nearly impossible in some country like the U.S. even. Obviously, you've seen the differences between how quickly really the Chinese government was able to shut things down, and then also how quickly they were able to really get things back up and running. Looking at some of the economic data, you saw upwards of an 80% reduction in business from January to February, which is really when their economy shut down, and then it almost entirely reverted back to normal with their March data. Again, not something that we would expect to see in the U.S., but I think that speaks to the I would say one of the few times that maybe it's beneficial to have that type of government in place. Now, that being said, we do think that there's some opportunity there longer term. So from an allocation standpoint, we do still hold some positions in emerging market because of that. I would say, again, more generally, still tilted towards the U.S., but that emerging market position is one that we hold currently, and we do see opportunity going forward.
Yeah, Austin, I don't know the answer to this, but I'm curious if you know. It seems like most of the research on whether it's a treatment or a antibody to this sort of virus seems like it's being done here. Is that accurate? And if so, is that you talked about healthcare earlier? Is that a tailwind for healthcare companies because it's all happening here, or is that inaccurate? Is it happening everywhere? Because it seems really like in the news, if you watch it, it's all happening here.
Yeah, I think it's fair to say that it is probably domiciled mainly in the U.S. Really, probably the main reason for that is the majority of these global healthcare companies, whether they be pharmaceuticals or medical equipment companies, they're all generally in the U.S. In terms of headquartered. So that's mainly why you're seeing that. Again, that would be a benefit to domestic equities,
Yeah.
but more specifically just within the healthcare space. I think that would be the benefit there.
So Austin, this is I'll say a super cool thing about doing a video conference live, and of course we'll look to share this with everyone who is watching, and welcome everyone sharing it with people they know. Questions on email as we're speaking. I just love it. So I'll ask this one, or both of them. How much of the volatility is computer generated, automatic buying or selling? And I'll follow it up with the next question that came from.
No, I think that's for sure a relevant topic in today's environment. I don't know that I would specifically put a number on it to say that it's X percent or a certain amount of the volatility. What I would tell you is it is maybe exacerbated both on the up and the down from a volatility standpoint. You actually saw that if we go back in time over the last 3-5 years. So when volatility has been low, it's been historically low, and that's contributed. So the benefit of computer-generated trading is it actually, in times of low volatility, allows for prices to be matched instantaneously that maybe otherwise wouldn't have, that allows for volatility to be even lower than maybe what has historically been viewed as the norm. Again, on the flip side of that, as you see prices jump in what we've seen maybe over the last month or so, it does exacerbate volatility to the upside a little bit too. Just maybe to put it in perspective, from a volatility standpoint, the volatility that we experienced in March for about a week straight was higher than any of the volatility that we experienced in 2008. So there's absolutely a component of that that is driven by the computer-generated algorithms, if you will, the trading that exists without really a human necessarily being in the midst. But I would tell you is that on the flip side, it does also add liquidity and improve things as well, just generally for the markets. So it's kind of a give and take in a sense, but it does contribute to some of the volatility that we've seen.
Sure, and just because I'll give a visual. We hit a sell point on computer generated, it automatically creates volatility. There's just no, and even and like you said, on the flip side, hit a ceiling and it automatically creates a buy. So I understand, and that's a great response. I do want to share this second question. With the loss of tax revenue, and I have more from clients literally coming in as I love that. With the loss of sales tax revenues in each state, how are they going to pay their bills?
Yeah, I think that's a great question, and I think realistically that's something that probably is still unknown today in terms of the sales tax revenue that will not hit the bottom line from a government standpoint or a tax receipt standpoint later this year and be factored into the 2020 kind of overall budgets, whether it's local municipalities or even at the federal level. What I would tell you is, and Lou, you touched on this earlier, the government has come out and said that there is kind of additional stimulus money already being discussed. And that would be one area where we've heard that conversations have taken place around how do you support the budgets of again, everything down to local government all the way up to the federal government when tax revenues aren't anywhere near what they would expect. And I think that would not be surprised to see that piece be part of another stimulus package down the road.
Okay, and we did have a few more, and I'll get to one more question, a comment by someone, and I think it absolutely should be stated. $1,200. That in a lot of cases won't, I'll say, move the needle if you're in a place like New Jersey. Any idea why the number was $1,200, or how will that impact or help those that may not live in New Jersey, as an example of a very expensive state?
Yeah, no, and I would completely agree. $1,200 in the grand scheme of things probably is a drop in the bucket, even for folks that are living maybe where cost of living isn't nearly as high as it is there, right? But what I would tell you is that the $1,200 is in addition to some of the other benefits that have been added kind of to as part of this CARES Act. And what I would tell you is it includes an increase in unemployment benefits. So normally, depending on the individual state, unemployment benefits are anywhere from $250, $300 a week on average. There's an additional $600 a week that the federal government is adding on top of that as part of that CARES package. So you went from, let's say, $300 to $900. The small business loans actually will be forgiven in many cases if those proceeds of those loans are being used to continue to support payroll within companies. So that would be another avenue for individuals to continue to get paid in this environment. Again, the $1,200 I would say it's not, maybe not the nicest way to say, but it's almost window dressing in a sense, that it looks good at the surface. But to your point and to the point of the question, in the grand scheme of things, a one-time payment of $1,200 isn't going to solve anybody's problems. It's the additional unemployment. So if you think an additional $600 a week, say you get that for 2 months, right? All of a sudden, that's almost $5,000 that's going towards the bottom line for an individual. Maybe somebody's going to continue to get paid where they didn't otherwise think they would because of those small business loans. Those are other areas that I would say are going to be much more impactful than that $1,200 stimulus check that, while on the face of it looks good in the headlines and may win somebody a popularity vote at some point in the future, I would make the case that other pieces of that legislation are much more important for the individual and supporting their financial stability over the next, let's call it, 6, 8, 12 weeks.
Very good. All right, thank you. So bringing it back to the market, obviously, again, looking past the last few days even, and the next few days, which look like they may be good, and we covered that early and said there's kind of no reason why. Yeah. But do you see at Horizon Investments, as a senior analyst, along with the team that you're working with, and again, I've had the pleasure of knowing them for quite some time, and I have tremendous respect for them as well. Do you see another leg down in this market? And if so, take us to the other side of that. When do you see that movement back up? And I understand, and I need to qualify for everyone, Austin he has no crystal ball in front of him. He's doing his best work as an analyst, which we are hiring him to do. But give us the leg down, what you see there, meaning loss, because we've had the discussion. It's not a drawdown, it's a loss. As the market slides, do you see another slide in the market? Possibly what type of slide? And when do you see it making its way back up?
Yeah, now, I think, and we've talked internally, wouldn't be surprised to see another leg down, as you mentioned. And the reason being is right now markets are driven on kind of the news cycle, whether that's news about the virus itself or economic news that continues to come out. Many of you probably have seen or have heard the unemployment statistics that have come out over the past couple of weeks, whether it be the payrolls number or the unemployment number just generally. That type of news, unfortunately, is going to continue to occur in the near term, whether that's broad economic data or also individual company data. We're starting, so at the end of this week, we'll actually get into earnings season for individual companies, and you'll start to see data come out from those companies that I can tell you right now is not going to be good. I think what we're watching for from a data standpoint is more, what are they projecting into the future, right? And that's the question, the million-dollar question, if you will. What I would tell you in terms of expectations, wouldn't be surprised on the downside if we were to what we call kind of retest the bottom, meaning that the bottom that we experienced there in the middle of March, where the market was down from the high in mid-February to the low in mid-March, about 37%. Wouldn't be surprised if we tested that bottom again, given some of the negative news that we're almost assuredly going to see. That being said, I think as we come out of this later this year, I think you do start to see a bounce back maybe more quickly than you did in a 2008, 2009 scenario. Because again, if you take a step back, going into the great financial crisis or the Great Recession at that time, really what you had was a structure that was starting to break down. Coming into 2020, I would tell you that you actually had a really strong economy, both domestically, but then also globally. As we get back on that footing, and again, it could very easily be towards the end of this year by the time we do that. But once you get there, you in high likelihood start to get a much stronger rebound and a much quicker rebound than you did coming out of 2008, 2009, just because of the underlying strength in the economy as we came into this.
And Austin, I think we use this term a lot, and we talked about it this morning on our call. So a couple just brief insights into our investment management team call this morning early. To set expectations, it wouldn't be setting the wrong expectation to say we're probably somewhat range bound from here. It depends on what you look at. Lou talks a lot about the Russell 2000 with his clients. Others talk about the S&P and the Dow, but there's probably some range that it wouldn't be surprising to you that we bounce around in between for now. And as you said earlier, really important point, the stock market is sort of a discounting, it's a leading indicator. We talked about an airline company just this morning as a group that's saying that revenues are going to be off 90%. However, a lot of that price in the stock's already been built in, right? That's important to know for people that fear the air pocket kind of underneath bad news to come.
Yep. No, absolutely. I think remembering kind of that idea of this discounting mechanism or forward-looking markets is really important, Josh, to your point that what we've seen and what we see currently in prices, hopefully in more cases than not, reflects the news that will be published today, tomorrow, or later this week even. What I would tell you is what we're looking for here at Horizon is what's going to drive the news that's going to be released a month from now, 2 months from now, because that's where really money can be made in the markets is if you're more forward-looking rather than reactive to news as it comes out.
And Austin, with just a few minutes left, a couple of things to touch on. We'll touch on politics just for a moment, okay? And first, I just for the record would like to say that more beneficial as a totalitarian government, thank you, is only more beneficial to the totalitarian government. All right, I'm sorry, I just have to throw that out there. Why can a single tweet have such an impact on the market? How can that happen? How can it be that one person? Now we understand who that person is and what, obviously, their position. How does that have such an impact? How has that changed what Horizon Investment is doing on a daily basis when a comment like is tweeted out by the president?
Yeah, and I think it's a really interesting time in which we live, not just in the current pandemic, but I would tell you just more broadly, if you think about how news is communicated. Think back, for that matter, not even probably 5 years ago, to previous administrations, and what you would see from a news release standpoint is it was a very structured, I would say in many cases kind of pre-canned set of items that was released or communicated. The idea of a tweet or kind of immediate communication is something that really this current administration has, in a sense, kind of taken and run with. And that's where we've really seen some difference, right? If you think back, again, previous administrations in the past, the communication that would be impactful to markets, whether it was talking about the economy, talking about a certain business, often came in the form of a scheduled news conference or a speech or something that was released. I would say it was released, but also known almost ahead of time. The market had time to digest the information rather than having information immediately thrown upon it. That is the exact opposite of where we sit today, again, with the current administration that has maybe taken full advantage of the technology at their hands. And not to say anything on the technology side of things, because I think we would all agree that technology has helped in so many ways. But what I would tell you is that the market is still learning to deal with this immediacy of information. So if President Trump wakes up at 3 a.m. and decides that he wants to deliver information to the rest of the world, he can do it. Whereas, 30, 40 years ago, if President Reagan had done the same thing, he had really no good avenue to even think about doing that, much less actually doing it. So you've seen this slow drip probably over the last 20 years in terms of the uptake from previous administrations, whether it was Obama being the first president with a Twitter account, just period. But I would say President Trump has taken that to a whole nother level in terms of how often and the types of information that is being put out on Twitter. Again, what I would tell you is, in the grand scheme of things, technology probably should be and is our friend. In this case, the market is really just learning how to digest that type of information that shows up so quickly in their inbox or on their phone that otherwise they would have historically maybe had more time to prepare for.
Very good. So with that, because we just have a minute or so left, so Austin is out looking for a financial advisor, and he of course hires Lou Tranquilli. Where is Austin investing his money right now?
Yeah. So, no,
I know I'm putting you on the spot, but I've got to do it. Where would you be looking right now?
Yeah. So me personally, obviously being a little bit on the younger side relative to probably other folks that are maybe on this call, I would absolutely.
Let me defend you didn't have to go there. All right.
But what I would say is it's entirely dependent on kind of the time frame. So for folks that maybe have more time to spend in the market, now is a great time to get into the market because you have the time to withstand any market volatility that does occur. Whether the market takes another leg down or not, somebody who has time to spend in the market really has that benefit of time being on their side. Folks that are maybe not as fortunate from a time standpoint, what I would tell you is that's where you have a product like what we call Risk Assist, or more of a tactical solution that works to keep you invested when it makes sense, but also protect you from market losses as they occur. And that type of strategy for a client with less time on their side is a great solution in today's environment for that objective, in that it helps to protect against any downside losses while still giving folks, I would say, exposure to the market in a systematic fashion as markets do rebound.
Yeah, Lou, I just want to pile in on that just to say that, we get this a lot. People are saying, well, these guys have insight. They're piling into this stock or that stock or whatever. We invest, Austin and I, and do the rest of my business partners all in the same strategies that your clients own, as long as to the extent they're with Horizon. So we're doing the same thing. I'm all in on some of our risk mitigation stuff, and I will tell you that I'm happy to say, as we're on this call, volatility has dropped quite significantly, which I think is more important than where the market is, where volatility is, helps us push assets potentially back into the market. That's exciting. So we're doing the same thing that your clients are doing to the extent they're invested with Horizon.
Very good. And I appreciate that. And I appreciate both of you. Everyone that's joined us on the call today, thank you so much for doing so. Again, your feedback is appreciated. An email would be great. We'll send out a recording of this video. Certainly wish everyone good health. And if you know anyone that is fighting this virus right now, we'll all have our thoughts and wish them the best, of course. So thank you all again. Thank you, Josh and Austin, for your time. And I'll speak with everyone very soon.
Awesome. Thanks, Lou.